You're sitting at your desk, staring at your brokerage account, watching your portfolio get absolutely demolished by market volatility. Your stock picks are down 20%. Your crypto bet, don't even get me started. You're watching your retirement fund shrivel like a plant you forgot to water, and you're wondering if you're just bad at this whole investing thing. Spoiler alert, you're probably not bad at investing. The problem is you're doing what everyone else is doing. You're chasing hot stocks, timing the market, listening to TikTok traders, and following the investing advice from people whose entire job depends on you making emotional decisions. My name is Lenny, and today we're going to talk about something that most Western investors have completely ignored. There's a proven investing methodology that comes straight from Japan, and it's been quietly creating wealth for decades while everyone else has been gambling in the stock market like they're at a casino. The crazy part? It's so simple that most people dismiss it immediately because their brains are wired to believe that good investing requires complexity. Good investing requires expensive advisors, complicated spreadsheets, day trading platforms, and the constant need to be plugged in, watching every market movement. But what if I told you that the most powerful investing strategy available to you right now doesn't require any of that? What if the secret to building genuine sustainable wealth isn't about picking winners or timing the market perfectly? What if it's actually about removing your emotions from the equation entirely and letting mathematics do the heavy lifting? Let me introduce you to something called the Nikkei buy and hold strategy, also known as the Japanese approach to long-term investing. This methodology was born from Japan's economic boom in the 1980s, and it survived something that destroyed most investing theories. The Japanese stock market crashed harder than almost any other major market in modern history. The Nikkei peaked in December 1989 at nearly 40,000 points. Then reality happened. The bubble burst spectacularly. By 2003, the Nikkei had lost nearly 80% of its value. It was a financial catastrophe that lasted over a decade. We call it the lost decade. But here's what's fascinating. The Japanese investors who stuck with their strategy, who didn't panic, who didn't try to time a recovery, who simply kept buying quality companies at lower and lower prices, actually ended up making tremendous wealth. They didn't succeed because they made brilliant picks. They succeeded because they removed the most destructive element from the investing equation, which is the human emotion of fear. The Japanese investing culture emphasizes something called long-term value investing, combined with what's known as cost averaging. You've probably heard of dollar cost averaging before. It's the practice of investing a fixed amount of money at regular intervals regardless of market conditions. When stocks are up, you're buying less share volume. When stocks are down, you're buying more shares at lower prices. Over time, this smooths out your average purchase price and removes the need to time the market perfectly. But the Japanese take it one step further. They don't just do cost averaging. They combine it with extreme patience and a complete rejection of the short-term mentality that dominates Western investing. The average Japanese investor doesn't check their portfolio daily, they don't panic sell during downturns, they certainly don't try to time exits and entries based on technical indicators. Instead, they pick quality companies, they commit to a timeline of decades, and they let compound growth do what it does best, which is turn regular small investments into life-altering wealth. Let me give you some context on why this matters. The average stock market investor in America holds a position for approximately 2 to 3 years. Some studies suggest it's even shorter. We're talking about people making major financial decisions based on time frames shorter than a typical car loan. In Japan, the average holding period for a stock is significantly longer. There's a cultural understanding that real wealth building takes time. It's not sexy, it's not exciting, it doesn't give you anything interesting to post about on social media. But it works. The mathematics behind this is actually brutally simple, and it's why every single person in their 30s should understand it. Let's say you're making a decent salary. You're not rich, but you're doing okay. You decide to invest $500 every single month into a diversified index fund that tracks the overall market. That's just $6,000 per year, at a typical stock market return of 10% annually, which is roughly the historical average. Here's what happens over 30 years. In year one, you invest $6,000. You earn about $600 in gains. You're ahead by $6,600. In year five, you've invested $30,000 total. But thanks to compound growth, your portfolio is actually worth roughly $38,000. You didn't add that extra $8,000. Time and mathematics did. In year 10, you've invested $60,000. Your portfolio is worth nearly $100,000. You've more than doubled your money without picking a single correct stock or timing a single market move. In year 20, you've invested $120,000. Your portfolio is worth roughly $360,000. Now you're seeing where this gets interesting. In year 30, you've invested $180,000. Your portfolio is worth approximately $1.9 million. You turned $180,000 into nearly $2 million just by being patient and consistent. Let me emphasize that number because it's important. You invested $180,000. You didn't time anything. You didn't pick the next Apple or Microsoft. You didn't call the market bottom in 2008. You just showed up every single month and invested the same amount regardless of whether stocks were up, down, or doing backflips. This is the Japanese secret that nobody wants to hear because it requires something that modern culture has completely erased from our brains, which is patience. We live in an age of instant gratification. We expect results immediately. We want to see our investments double in 6 months, or we assume something is wrong. But the Japanese approach understands something fundamental about markets that most Western investors miss. Markets are volatile in the short term. They're basically unpredictable. You cannot reliably predict whether the stock market will be up or down next month. No expert can do it consistently, and anyone who claims they can is either lying or getting extraordinarily lucky. But markets are reliably profitable over long periods. History shows us this with absolute clarity. Even during periods of tremendous economic disruption, even during wars and recessions and financial crises, if you stayed invested in quality companies over a 30-year period, you made money. The Japanese investors who stayed disciplined through the lost decade understood this. They didn't try to outsmart the market. They didn't hire expensive advisors to pick winners. They didn't sell everything and move to bonds. They did something almost absurdly simple. They kept buying. And here's the really important part. They bought more when stocks were cheaper. During the crash, as prices fell, their regular monthly investment was buying more shares. This meant their average purchase price was lower than it would have been if they'd been investing during the boom. This is the actual magic of cost averaging that most people completely misunderstand. Most people think cost averaging is just a boring way to invest. They think it's for people who are too lazy or too stupid to time the market correctly. But what it actually is a mathematically superior approach that removes human error from the equation. Think about it this way. Every single stock picker, every single market timer, every single person who tries to outsmart the system is trying to do something that is statistically nearly impossible. They're trying to buy at the bottom and sell at the top. Over a 30-year period with multiple bear markets, multiple corrections, and countless false signals, this requires you to be right multiple times. The cost averaging investor doesn't need to be right even once about market timing. They don't need to know when the market will crash. They don't need to predict recoveries. They just need to show up consistently. Now let's talk about what happens when you combine this strategy with the specific stock selection methodology that Japanese investors use. The Japanese don't believe in picking trendy growth stocks that might go bankrupt next year. They focus on established, profitable companies with strong fundamentals, consistent dividends, and a history of surviving economic cycles. In America, we're obsessed with the next big thing. We're looking for the startup that will become the next Google. We're chasing AI stocks in 2024 like they're going to immediately make us rich. We're completely ignoring the fact that most startups fail, and most growth companies never deliver the returns that investors initially expect. The Japanese approach says forget the excitement, buy companies that have proven they can make money for decades. Buy companies that pay you to wait through dividends. Buy companies that have survived multiple economic downturns and still came out profitable. This is boring. It's so boring that financial news channels don't talk about it. There's no narrative tension, there's no excitement. You can't explain boring investing on television in a way that keeps people watching commercials, but boring investing is the investing that actually works. This is something that Warren Buffett has been saying for decades, but for some reason, most people don't believe him. They think his approach was special somehow, that he had secret information or exceptional talent at picking stocks. The truth is much simpler. Warren Buffett's approach is almost identical to the Japanese methodology. He buys quality companies, he holds them for incredibly long periods. He doesn't panic during downturns, he actually sees downturns as opportunities to buy more of quality companies at lower prices. He's been doing this with such consistency that it's created generational wealth. Not because he's a genius trader, but because he understood that boring and patient beats exciting and emotional every single time. Now let's talk about what prevents most people from actually executing this strategy successfully. The biggest obstacle is something called recency bias. Your brain is constantly telling you that recent events are predictive of the future. If the market just had a great year, your brain is screaming at you that it will continue to have great years. If the market just crashed, your brain is convinced that it will continue crashing and you're going to lose everything. This bias is deeply hardwired into human psychology. It's probably there because it kept our ancestors alive on the savannah. If there was a predator around yesterday, your brain wanted you to assume there would be one today. But the stock market doesn't work like a predator attack. It doesn't follow the patterns of recent history. The market that was up 20% last year might be down 15% this year. The year you're most terrified to invest is often the best year to invest because prices are lower. The Japanese investors who did well through the lost decade had to actively fight against this bias. Their brains were screaming at them to sell, to get out, to wait until prices recovered. But they understood that if they followed those urges, they would lock in losses and miss the recovery. This is where the systematic nature of cost averaging becomes incredibly powerful. It forces you to invest regardless of your emotions. It removes the decision-making process from your conscious brain, which is terrible at market timing, and puts it into a simple mathematical formula that works regardless of how you feel. When the market crashes and your brain is screaming danger, your system still invests your $500. When the market is booming and everyone around you is making money on speculative bets, your system still invests your $500. You're not trying to make the smart move, you're letting mathematics make the move for you. This is radical in the context of modern investing culture, but it's completely normal in Japanese investing culture. There's an assumption that you are not smarter than the market. You cannot reliably beat it. The best you can do is capture the market's overall returns, which are substantial when compounded over decades. Let me give you another example of how powerful this becomes, because the math gets even more crazy when you extend the timeline further. Let's say you're not just 30 years away from retirement. Let's say you're young enough that you could maintain this strategy for 40 years. You maintain the same $500 monthly investment. At 40 years with 10% average returns, your portfolio isn't worth $2 million. It's worth roughly $3.5 million. You've invested $240,000. Your investment has become more than 14 times larger. At 45 years, which might be relevant if you're starting this at 20 and want to continue until 65, your portfolio reaches approximately $5.5 million. You've invested $270,000. Your money has become roughly 20 times larger. This isn't some theoretical fantasy, this is what actually happens when you compound returns over long periods. This is what the Japanese understood that most Western investors completely miss. The power isn't in picking winners, the power is in time, consistency, and not being stupid about market timing. But here's what most people do instead. They start investing with great intentions. They're excited about building wealth. They throw money into the market. Then the market has a 10% correction. Their portfolio drops $3,000 in a week. Suddenly, it doesn't feel like a good strategy anymore. It feels like they made a terrible mistake. So they panic sell at exactly the wrong time, locking in losses. Then they wait for the market to recover. Once it's recovered and they're feeling better, they get back in at higher prices. By that point, they've completely eliminated all the gains they would have made and added trading costs and taxes on top of everything. This is the emotional roller coaster that keeps most people poor. The Japanese investors who succeeded understood that those 10% corrections are not reasons to change the strategy. They're normal features of market participation. They happen regularly, they're temporary. In fact, they're gifts. When the market crashes, your regular investment is buying more shares at lower prices. Your average purchase cost is being dragged down. You're getting richer during downturns, not poorer, as long as you maintain the discipline to keep investing. This is almost impossible psychologically. Your brain wants to protect you from losses. Your brain wants you to run when things are scary. But your brain is not a good financial advisor. Your brain kept you alive in a dangerous world. It's terrible at making investment decisions. This is why the Japanese culture of long-term investing is so powerful. It's not just a strategy, it's a philosophy that says, I'm going to remove my own judgment from this equation because I cannot be trusted to make good decisions when I'm afraid. Now let's talk about what specific vehicles you should use for this strategy in modern America. The Japanese approach would translate into investing consistently in low-cost index funds. These are funds that track broad market indices like the S&P 500 or total market index funds. The reason index funds are superior for this strategy is that they eliminate individual company risk. You're not betting that one company will succeed, you're buying a tiny piece of all the major companies in the market. Some will succeed spectacularly, some will fail. But on average, they'll deliver the market's historical returns. This is something that most actively managed funds cannot do consistently. Study after study shows that professional fund managers underperform index funds over long time periods. They charge higher fees, they trade more actively, creating more taxes and more transaction costs. They try to pick winners and they fail more often than they succeed. An index fund invests in 500 companies. It doesn't try to pick winners. It just owns everything. Over 30 years, this approach has outperformed active managers about 80% of the time. The Japanese understood this intuitively, even before the research proved it definitively. The specifics of your investments matter far less than most people think. What matters is that you invest consistently, that you hold for decades, that you don't panic during downturns, and that you minimize your costs. Which vehicle you choose matters, but it matters far less than your behavior. You could invest in a total stock market index fund. You could invest in dividend aristocrats. You could invest in a mix of stocks and bonds based on your age. The specific allocation is less important than the fact that you have an allocation and you stick with it, regardless of market conditions. Here's another thing the Japanese investors understood that modern Western investors completely miss. Dividends are not a bonus that you get if you're lucky. Dividends are actual returns on your investment. When a company pays you a dividend, that's cash money flowing to your account. If you reinvest those dividends, they start compounding immediately. The power of dividend-paying stocks is that they provide real cash returns while you're waiting for the stock price to appreciate. This is incredibly important psychologically because it makes you feel like your investment is actually doing something while you wait. You're not just hoping the stock price goes up, you're getting actual payments. Over 30 years, reinvested dividends can account for roughly half of your total returns from stock market investing. People focus obsessively on stock price appreciation, but dividends are doing half the work while they're not paying attention. This is another reason why the Japanese focus on established, profitable companies that pay dividends. These companies aren't just holding your money. They're actively rewarding you for your patience. They're sending you cash every quarter. If you reinvest that cash into more shares, you're amplifying the compounding effect. Now let's address the elephant in the room. Everyone's thinking, what if the market crashes and never recovers? What if this time is different? Let me be direct. If the stock market crashes and never recovers, it's not because of market risk, it's because civilization has collapsed. We're living in a post-apocalyptic scenario. At that point, your stock portfolio is the least of your concerns. The stock market has survived the Great Depression, multiple wars, recessions, financial crises, the dot-com bubble, the housing crisis, the pandemic, and countless other catastrophes. It's been declared dead more times than Jason from the Friday the 13th movies. Every single time, people convinced themselves that this time was truly different, that the market would never recover. And every single time it recovered, because the fundamental structure of capitalism continued. Companies continued making products. People continued buying things, profits were made, stock values increased. If you believe that America and capitalism are going to collapse, then yes, your stock market investment might not work out, but your house won't be worth anything either. Your bonds won't be worth anything. Your cash will be worthless. Everything that's traditionally considered safe becomes dangerous in a true collapse scenario. The Japanese investors in the 1990s were probably thinking similar things. The lost decade kept going longer than anyone expected. People were convinced that Japanese stocks were broken forever, but they eventually recovered. The investors who stayed disciplined became incredibly wealthy. The investors who panicked, sold, and moved to bonds guaranteed themselves much lower returns. This is the harsh lesson that history keeps trying to teach us. When things are scary, when the losses are real and present and visible in your account, that's exactly when you want to be buying more, not less. That's when discipline becomes incredibly valuable. That's when being Japanese about your investing, instead of American about it, actually saves your financial future. Let me give you one more practical example to drive this home. Let's say you're earning $50,000 per year after taxes. You could invest 10% of that, which is about $420 per month. That's barely noticeable to your lifestyle, but over 30 years, it becomes approximately $1.5 million. That's assuming you never get a raise, never increase your investment amount, and never do anything except show up every single month and invest the same amount. Most people will get raises, most people will eventually increase what they're investing. Most people will get bonuses or come into small amounts of money that they could add to their portfolio. When those things happen, your wealth compounds even faster. But even if your life stays exactly the same, if your salary never increases, if nothing good ever happens, you still become a millionaire through absolute consistency and patience and boring mathematics. Now, what prevents people from actually doing this? The biggest obstacle isn't lack of ability, it's lack of belief. People don't believe that boring actually works. They've been sold the narrative that real wealth comes from excitement, from picking winners, from being smarter than everyone else. That narrative is perpetuated by people who profit from activity. Brokers make money when you trade. Advisors make money when you pay them fees. Financial news networks make money when you watch constantly trying to keep up with everything. None of these entities profit when you invest $500 monthly in an index fund and forget about it for 30 years. The financial system has built an elaborate structure designed to convince you that you need to do more, change more, be more active, constantly adjust your portfolio, listen to expert advice, read market commentary. All of this activity comes with costs and taxes and friction. All of it works against your long-term wealth building. The Japanese approach short-circuits this entire system. It says your role isn't to be smart or active or constantly optimizing. Your role is to be consistent and patient and boring. Your job is to show up and invest the same amount every single month for decades. That's it. That's the entire secret. And it works, not because it's clever, but because it aligns with how markets actually function. Markets reward patient capital. Markets punish emotional decisions. Markets reward consistency over trying to catch every move. Markets reward decades of compound growth over attempts to time short-term fluctuations. The Japanese investors who built wealth through the lost decade and beyond weren't geniuses. They weren't picking special stocks. They weren't reading obscure technical indicators. They were doing something that looked incredibly boring from the outside. They were investing consistently in quality companies and waiting a very long time. If you're in your 30s right now and you implement this strategy, you could realistically have between $2 and $5 million by the time you're 65. That's not a fantasy, that's mathematics. That's what compound growth does over 30 years. The question isn't whether this works. History and mathematics prove that it works. The question is whether you have the discipline to do something that feels boring, that feels like you're missing out on exciting opportunities, that feels like you're not being smart or active enough. That's the real test. Not intelligence, not luck, not secret stock picking ability. Just discipline and patience and the willingness to let mathematics do the heavy lifting while you go about your life. This is the Japanese secret that's not actually a secret at all. It's hiding in plain sight. Everyone can see it. Most people choose not to look because they're waiting for something more exciting. They're waiting for a better strategy. They're waiting to learn the real secret. But there is no real secret. There's just compound growth, time, and consistency. That's literally it. That's the entire Japanese strategy for building wealth through investing. And it's more powerful than any trading system, any stock picking method, or any clever financial technique that exists. So here's what you should do practically. Open a brokerage account today. Set up an automatic investment of whatever amount you can afford. Make it automatic so you never have to think about it. Invest in a low-cost total market index fund. Then forget about it. Check your account once or twice a year, not daily. Let the decades do their work. Don't try to time the market. Don't panic when the market crashes. Don't get excited when the market booms. Just show up every single month and invest the same amount. In 30 years, you won't believe how wealthy you've become on a boring, consistent, mathematically simple strategy that any person with an internet connection can implement. This is the Japanese secret investing strategy that every person in their 30s must know. It's not about being smarter than everyone else, it's about being patient longer than everyone else, and patience, when combined with decades of compound growth, creates more wealth than any amount of cleverness ever could.